Hi everybody, this is Cal from Trade with the Boys. Now, this video is pretty important and I want you to take note of the things that I'll be sharing today. To me, we are probably going to see the reminiscence of the 1929 Great Depression coming up soon. Now, I'm not saying that we will be having that Great Depression as compared to 1929, the aftermath was 1930 to 1940. Now, I'm not looking at that type of magnitude, but of course, I'm looking something near to that. Yes, apparently, if you look to this at the bottom down here, the previous number that I gave was still 22,908. But today, I am putting a fresh number, and the number is 18,865. Now that means that the current Dow Jones now is trading at 24,150. I'm looking at 18,865. So we're talking about 5 to 6,000 points away. Now I'm not saying that this will happen in the intraday. It's not possible. But I'm looking at it to happen along the way. And I believe that probably by June or July, we might be able to see this. Now what's my reason for that? Let me show it to you now. Now, basically, we know that the central bank are stopping their buying of the bonds. Now, they have been the world's biggest buyers of the government bonds, and then, being the main buyer, they have to sell. Because if they don't sell at a high price, they would not have the ammunition to come back again to save the market. So apparently, in a May report from the Wall Street Journal, we see that the central banks have been the biggest buyer, but this may come to a stop pretty soon, and it's actually happening. In my previous video, I have already shown to you that it is happening. The four main banks, right, they are all liquefying their asset bit by bit to the open market. Now, Ray Dalio, all right, now the hot star, Bridgewater Associate co-chairman and founder, okay, he is saying that crisis is always self-correcting mechanism. So he is very true. It will, how the market goes up, or technically how it comes down. And there's a very important statement he said on Bloomberg recently. He said this: we are in a period similar to 1935 to 1940. Now, 1935 to 1940, that was a Great Depression where things are going bad. But we don't see it happening, right? Still, things are pretty okay. But that is only on the Asian side. But you look at Venezuela, Brazil, Argentina, Turkey, things ain't like this. In fact, things are really happening there, and people are losing jobs. Inflation is going above 30%, and things are still getting to worse. Now, if we look at into the last 170 years history, okay, this is the price earning ratio. You can see that in 1901, it hit to 25, but incredibly in 1929, it hit the point of nearly 33. And after that, we saw the market just collapse, right? Now, back then in the South, right, the interest rate factor, it was still at about 10%. But as we know today, we are no more than 3%. But the problem is the price to earning ratio, we are back to 1929 level once again. This is the most updated chart I can give it to you, and this is very, very scary, okay? The smart money has left. Okay, that is very clear. Bloomberg Smart Money Flow Index. You can check online. Okay, I don't get you stuff that is just plucked from the market, but from the internet. But it has to come from some very respectable social media or mainstream media. And Bloomberg said this: the smart money are living, and you can look carefully. They have left since the early start of 2018, and they're still on the way out. Now, there was some reports saying that some funds came in during the recent sell-off, but you must understand the amount that went out versus the amount that came in is less than, it's like 5 to 1 ratio. So even the recent money that came in, right, it could be just a temporarily buying back, all right, on cheap, like the FANG stocks, or you just buy some just to hold on to the position. I'm not too sure, all right? But for CNBC, it is very clear that Moody has warned particularly large wave of junk bonds default coming ahead. And this report was in May, and it seems to be that the debt to US company has surged more than 49% since the crisis, with many higher rated firms using it back to buy shares and issue dividends. So you can see now basically the companies are using these bonds to basically increase the share buyback and issue dividends, and that's why price went up in July to September period. But when you do that itself, the debt increase, so this is things that you don't want to carry, especially the next earnings season. So now what we are seeing now is that basically mortgage rates have been rising at a pace not seen in almost 50 years. So what does it mean then? People are selling, people are mortgaging because people need the money. And this is something very clear that the government knows, but they decided to keep it quiet for time being. Because retail defaults, my goodness, from CNN, defaults are soaring. Now, it is so incredible to see Toys R Us going down, Sears going down, and so many big companies are going down. Is it because of the internet era where people are spending money online? I don't think so, because this is something we have to look into this. Yes, we have seen pretty good earnings from Goldman Sachs yesterday, but it doesn't mean it represents everybody. And look carefully, Goldman Sachs' main earning came from where? It came from the borrowing division. That means they lent out a good deal of money and people been returning in kind, okay, because of the interest in money. But the point is this, it's just borrowing, it's not from the business in total. So this is something very, very important for a trader to watch out. And this is the bank that I'm very, very afraid of. Because if Deutsche Bank really start to cut more jobs, there's only one reason for that. Now, Deutsche Bank from a high of $16 early this year is now to $8 to $9. It went down almost more than 40 to 50%, and this is very, very important. Now, Deutsche Bank has huge exposure in the derivatives market, almost $40 trillion. So this one you can check on their balance sheet, it's online. Okay. Now, watch this carefully. If let's say Deutsche Bank can't get out or unwind the position, and should the market go in a drastic manner, alright, this is going to be very, very scary to a lot of traders, and this could be very damaging, because if Deutsche Bank goes down, it's equivalent like what happened to Lehman Brothers. It's equivalent, okay? This is my open personal opinion. You can just do your own reference and check with your financial advisor, and let us see what happened next. Now, this is the 1790 US debt to GDP. You can see the different timing where we have the Revolutionary War, the Civil War, the 1918 War, and so forth, right? Now, what I'm trying to see at this point here, right here now. Now, in 1946, this is where we have, okay, this big movement here, the debt. Now, we are again at the same point once again. Now, this is scary because the next chart will tell us that why we need to be very afraid of, because now we can see the movement here. The federal debt and the unfunded liabilities have went up all the way high to the similar level of the Lehman Brothers crisis. It's the similar thing, okay? But the problem is that the GDP ratio and the population rate growth is all going downwards, okay? This is it's worse than what happened. This is worse than what happened back in 2009. So things are getting back to worse, and the debt is now at the same level versus 2009. So if I were to see this as a point of contact here, I am expecting the market will go worse than 2009 Lehman crisis. It could go down and reminisce the exact what happened in 1929, and this is going to be very scary. So of course, on CNBC, Morgan Creek Capital, one of the fund, are looking at a 40 to 50% retracement. Okay, now this thing was taken up in October 2018. So we are talking about how much? 14,000, 12,000 level? Well, I'm not too sure about that. But the thing is this is coming from a hedge fund. Okay, so obviously you can check on them and see whether they did change their current valuation. But if not, Mark Mobius, I think this guy, everybody knows him. He has said there could be a potential 40% stock market downside, and that was in May. And he was totally wrong, because from May onwards, the market went all the way up until a new high. So he was wrong. Remember, he was wrong. But of course, eventually, if the market do come down, he might be right again. So I'm going to say this up front. Not all big boys are perfect with their analysis, including myself. Okay, I'm not a big boy even. Okay, there's something to take a notice on that. So now, Paul Tudor Jones. Okay, this is a hot shot trader, hedge hedge fund expert and been in the market. He made piles of money in 1987 Wall Street crash, and he now is saying that we are having a global debt bubble and we are heading towards some scary moment. Now, this was said on 15 November, and you should know what happened. After 15 November, that day the report came out, the market slammed down all the way down in November, and then in December, and you can see the market went down from 26,951 all the way down to 21,459. So you can see this is why this guy, Paul Tudor Jones, is so highly respected, because whatever he say, it will likely become the truth. So now he have on video on CNBC, go and look at it. He is saying we are in a global debt bubble, and this video is pretty good and pretty clear, and he was pretty decisive. He was pretty content based with whatever he been sharing. Okay, so this is what is happening globally, and this is why I believe that 1929 reminiscence of what happened could really happen. Jobs will be lost, people will be losing great deal of money, and when will this be happening? Now, there is something that I want to show you through the chart. Okay, let me bring you to the chart now to show you my point. Now, this is what is happening now. Oops, sorry. Okay, now look here. This is the Dow Jones chart. That's the high 26,951 and the low of 21,560 around there. Okay, should be 461. Should be. All right. What happened is that this numbers that is on my chart is all computed by the calculator, a simple calculator. So now there is number that I've been monitoring and I've been watching, and yesterday it was traded. Yes, yesterday. Yesterday the Dow Jones went up to the high. Okay. Oops, sorry. There's something wrong with the terminal. Okay, doesn't matter. The thing is that the Dow Jones went to the high, okay, above 24,255, and then the last half an hour or so, it pulls back down. Now, this is actually a pretty scary thing. To pull back down at this technical point, 24255. Now, watch it backward here. You can realize that this point, seemingly were the key support level. And when the market broke below it here, that's why the market went all the way down more than 2,000 points, all right, in a span of less than 7 days. But now the market is returning a very sharp V recovery back to here. So I'm going to say this up front. If the Dow Jones can stay above 24,255, whatever I just said earlier itself could still be lingering, but it's not that worry. But if the Dow Jones cannot stay above 24,255 the next 2 to 3 working days and pulls back below 24,000, I'm going to say up front here, we will see the market dropping down to 22,908. Okay, that is the first level. Now, if the market continue to drop below this 22,908 and goes below this 22,234, this is a very important technical point. The market must hang there. It has to stay above it. Okay, anytime the market, the next 2-3 weeks, okay, because I'm going to be away, all right, 2-3 weeks to 2-3 months, if the Dow Jones goes below the low of this guy, wow, this will send the Dow Jones down pretty badly, and I'm going to say up front, we will probably see the 18 level, okay, the 18,865 level that I mentioned very beginning of this video. Okay, now let me say this once again. Above, fine. Below, very break here, oh no, break this point, you are in for trouble. All right, so this is Cal from Trader Boys, and I hope you like this video. I sincerely hope the market will not behave as what I said, but shall it be? Please protect yourself and make sure you have a lot of money on the side, because cash will be king by then. Till next time, this is Cal. Bye bye.